Congratulations, you made it through loan processing and are ready to close your loan. If you joined us for our previous videos on the mortgage loan process and are finally at the finish line, congratulations. At this point, the loan file has already been submitted for final approval. Basically, the loan officer, processor, underwriter, and closing team have given it one last look over to make sure that all of the I's are dotted and the T's are crossed. Then, the final closing disclosure will be prepared. This document is very similar to the loan estimate that you received at the beginning of the process, but has now been updated with all of the final costs of the loan. You might be asking, why did that change? Well, the simple answer is that there isn't a way to know for certain what all of the loan costs will be at the beginning of the process. For instance, say that you'd been planning on closing near the end of the month, but the appraisal took a few extra days to complete, so you aren't actually signing until the beginning of the next month. This can affect how many months of property taxes and homeowners insurance are collected in your escrow account, along with what's being referred to as prepaid interest. Since the first payment on your new mortgage won't be due for several weeks, the lender must collect some of that interest before closing. Like this, $585,000 at 5% is $79.56 of interest per day. If closing on the 10th of November, there are 20 days left in the month before December payment accrues. $79.56 times 20 days equals $1,591.20 in interest due at closing. Unfortunately, there isn't a crystal ball that determines exactly what day a loan will close, so the loan estimate is meant to provide an approximation of the fees and costs, whereas the closing disclosure has the final numbers for everything. This document will most likely be sent to you to sign electronically through your email in order to ensure that it was delivered and the mandatory 3-day waiting period can begin. This is important as it provides you, the borrower, with the chance to go through all the numbers yourself and make absolutely sure that you're okay with the loan payment and the fees that are being charged. You can still back out of the loan at this point if you decide to, so it's a good idea to take this one last moment to review everything. Soon after the closing disclosure is signed, the actual loan closing will be scheduled. This involves all of the borrowers going to the escrow company or attorney's office to sign the final paperwork, though the use of a mobile notary service is becoming more popular in some areas. After the signing occurs, any funds due at closing for the down payment and such will need to be wired to the appropriate office for disbursement. If you're buying a new home, you'll typically receive the keys to the property at this point. But if you're refinancing a current home, you'll have an additional waiting period referred to as a 3-day right of rescission. Since your current mortgage will be paid off and closed, this extra time allows you additional opportunity to make sure that you feel comfortable with the new loan terms and payment before it becomes permanent. Then, the escrow company will handle transferring all of the funds to pay off either the seller of the home or the existing mortgage loan, and record the paperwork necessary to start the new loan. After closing, the loan transitions into what's called servicing. Usually a few weeks after signing all the papers, you'll receive a notice from your loan servicer, either in the mail or via email, prompting you to choose how you'd like to make your monthly payments. The notice will provide information about when your payments are due, the late penalty if you happen to miss a payment, and the amount that will be set aside in your escrow account for your annual property taxes and insurance. Hopefully, your loan officer already explained that though your principal and interest payments are set for the life of the loan, well, unless you opted for an adjustable rate mortgage, the property taxes and insurance typically fluctuate on an annual basis, every year around the same time that you close on your loan, and that's it for the mortgage loan process. You started this journey by choosing a loan officer and getting pre-qualified. You made it through the loan application, processing, underwriting, and closing phases, and now you're ready to continue on your journey as a homeowner. Thanks for joining us, and be sure to check out our other content. Take care.